Good evening, ladies and gentlemen, and welcome to our webinar, which is sponsored this evening by Alvexo. Alvexo is one of the leading regulated providers in the marketplace, as you saw in our introduction. And if you can't access their site, that means they're not regulated in your home country. But if you go to www.alvexo.com during this class, you can open up a demo account by just simply putting in your name, email address. There's no credit card and no deposit required. And then you can use their charts and follow along with us as we discuss technical indicators tonight. Now, tonight's class is being recorded, and you can see a recorded version of this class in about 24 hours by using the same link you used to come to tonight's class, or when they have some chance to edit it, it will also be available on investing.com under Education tab, and then look for webinars on demand. And in fact, you can see all of our classes on investing.com. Now, because Alvexo is a regulated provider, I need to give you a risk warning, so let me read that and get it out of the way. Trading Forex, CFDs, and spread bets on margin carries a high level of risk and may not be suitable for all investors. You may lose more than your initial deposit and could be required to deposit additional funds. Please ensure you fully understand the risks and take care to manage your exposure. So let's get ready for learning about technical indicators. Now, I've given you two handouts available in tonight's class, and they're only available in the live class. That means right now, because when you see a recorded version of this class, you will not be able to download them. So please click on the download buttons you see on your screen and download them to whatever device you're listening to us this evening. You can move them at a later time, but you will not be able to access them any other time besides right now. So I've tried to put together a handout for you called Understanding Technical Indicators, which will go over all the types of indicators we talk about tonight. And I've also given you investing.com's Introduction to Technical Analysis that'll walk you through all the fields of technical analysis and give you a good understanding. Now, traders who subscribe to technical analysis operate under the fundamental theory that price moves in patterns and that price never lies. Now, to the inexperienced eye, a financial chart may look like an unpredictable line of a jumble of colors and marks. But these traders are watching charts to pick up on the subtlest of indicators of where price could be headed next. Now, the field of technical analysis is broken down into many categories. Too many traders or too many newbies or too many online traders think that technical analysis is all about indicators, things like RSI, MACD, stochastics. But this is only one tiny field. Now, tonight we're here to discuss that field, which is technical indicators, which is a small section of the overall technical analysis. But the main similarity between all technical analysis indicators, whether you want to use MACD or some esoteric one, or you want to use RSI or a basic one like a moving average, is they all are based on basically 5 pieces of information: the open, the high, the low, and the close, and the volume. That's it. Price is price. There's not much more you can do. Now, there's all different types of mathematical equations you can add to it, all types of smoothing ways and standard deviations, and all types of framework you can add to it, but you're only using an open, a high, a low, a close, and a volume. That's it. And this small number of variables to produce hundreds and even thousands of trading indicators. Now, the fact is, it has produced a lot of trading indicators. Okay. And with the development of online trading and Java charts and HTML charts and the use of computers, we have lots and lots and lots of these new indicators coming on the market every day, and different gurus pushing them and promoting them, and things becoming all the rage for the moment. But the fact is, when we break them all down and look at all the success ratios, it all comes down to the oldest and most well known because they've been tested with time. And the thing about an indicator, it may work in today's market, it may work in tomorrow's market, it may work great for the next month, but when the market changes, it doesn't make that change along with the market. So by not using ones that have been tried and tested over time, you can find you're using something that some guru was pushing to you out there that worked last year and doesn't work anymore. It only works now and then. So back testing is one way that we can check indicators, but that takes a lot of time. Me, I've been trading for 40 years, and guess what? I still use basically the same indicators I used when I first started out because I can trust them. And really, once you find an indicator you understand, the more you use it, the more you can find its advantages. Now, technical indicators fall into two main categories. And these are called leading and lagging. And the fact is, you have to understand what each one of these technical indicators, not how they're calculated, but what they do. Because a lot of people I come across use three of the most popular ones, but they all turned out to be momentum indicators. You need to know what categories they fit, whether they're leading or lagging, and then where they fit, so that you're not using the same ones that give you the same information, because otherwise you're getting the same basic information. Now, in English, the terms leading and lagging also come with a connotation. You know, we all think anybody who's a leader is great and best, and those who are laggers or lag behind are worse. In school, you have the leaders in class and you have the laggers or the slackers. This is not the case when we come to technical indicators. Leading and lagging are not good and bad. They're not positive and negative. Leading indicators are those who lead price movement. They give a signal before a new trend or a reversal occurs. Doesn't guarantee it's going to happen. They just give you a signal. Think of them almost as an alert. Where lagging indicators are those who follow the price action. They give a signal after the trend or reversal has started, or they are a confirmation. Now, indicators from both categories also fall into types. We have trend indicators, we have momentum indicators, we have volatility indicators, and volume indicators. Now, some indicators like MACD fall into several because they give you several different pieces of information. So a technical indicator, though, is a mathematical calculation that can be applied to an asset's past patterns like price or volume, or even another indicator. You can analyze another indicator and give you some type of alert and they predict or they can confirm. Okay, that's basically all that they can do. Technical indicators do not analyze any part of fundamental analysis or business. They don't take into account news. They don't take into account earnings statements. They don't take into account profit and loss or increased sales. No, they deal only with price action on charts. So technical indicators are most extensively used by active traders in the market, as they are primarily designed for analyzing short-term price movements. To long-term investors, most technical indicators have very little value because most long-term indicators are looking for something to go up over a long term. They're more concerned. Now, trend lines could call into the area of a technical indicator, but not so much. Now, the first category or sector we have of these indicators, they're called trend indicators. They identify trends over different time frames and help you clear the news out of market volatility. Any type of trend, including uptrends, downtrends, and sideways trends, can be traded for profit as long as it's shown itself to be consistent. Trend traders use a number of different indicators to help them figure out what kind of trend an asset is in. One of the most popular of these indicators is moving averages, which is represented by a single line that represents a stock or assets average over a given period of time. Now, for instance, in the Forex market or CFD trades, or our short-term market, we could take a 5-period moving average, a 20-period moving average, and a 65-period moving average. And when they diverge from each other, it will tell us that we're having a longer-term uptrend. When they converge, it would tell us we were in a downtrend. So let me show you overall what we're talking about. Hold on, let me pop up a price chart here. Okay, so we can turn on. Now we're going to set up, but as you can see, we now have 3 moving averages on our chart. Oops. We have the yellow, which is a 60 period moving average, the blue, which is a 20 period moving average, and the red, which is a 6 period moving average, a 7 period moving average. Now, these are ones that I took and I use. Okay, you can use any 3. What happens is these combine together, and when the longer term moving average diverges from the shorter term, we know we are in an uptrend. When the medium term or the intermediate term, which is a 20 period, crosses over or comes close to the red period, means we're moving into that uptrend is no longer happening. And when that blue shorter period moves over the red period, tells us we're moving over into a downtrend. It's just an indicator, but it helps us analyze the markets. It helps us see the trend and verify that we actually have a trend taking place. To understand it more, you need to come to our class on moving averages. But there's other examples of trend indicators. These include one, it's my favorite, moving average convergence and divergence, MACD. We have ADI, average directional index. Okay, we have line regression. Okay. But these are one category. They help us identify a trend or whether price is moving in a trend or a trend has begun. Then another category we have are called volume. Volume, of course, is the measure of the total number of shares or contracts that trade in a given time period. Where volume really comes in handy is for confirmation. Many traders use volume to confirm the conclusion of another type of indicator, such as a trend. Well, doesn't it make common sense that if a market is moving in a trend and there's a buy opportunity, that the volume of traders entering that market and buying would be increasing? If we don't see an increase in that market and the buying in the market, and we think we see an uptrend, then maybe we should go back and reconsider it. So here, I'll show you how on a chart, how we might want to use this. Uh-oh. I lost my chart that had my volume pattern. But here we can see volume is placed on your chart down below, or a volume indicator. And we can see here as oil reached its support line and then started moving back up, we can see all the traders using this volume indicator jumping back into the market to buy. We see volume easing back down and selling going on here, and we see the price turn downward. So this would help us see overall price movement, and these are volume indicators. Okay, and there's many different volume indicators that we can use. Hold on one second, I'm just trying to get my markers up here. So sometimes market conditions or lack of liquidity alone can temporarily drive an asset higher or lower. However, these moves often occur on relatively low volume and can be short-lived. On the other hand, if an asset makes a big move on extremely high volume, that's a reliable signal that there's major buying or selling going on, and the move should be taken serious. So we have volume indicators that include money flow index, change in money flow, on balance indicators, demand index, and force index. There's many different ones that fit this category of volume indicators. Then we come to momentum indicators. Momentum indicators are like speedometers for traders. And momentum indicators for us, for short-term CFD trading, is very, very important because we only want to trade where there's momentum. Okay. Because we're only going to make profit by an asset that's moving up or down. An asset that's moving sideways or hardly moving at all is very hard. You know, it may be in a slow pace up move, but it's hard for us in a CFD format as an intraday or day trader to make a profit out of that. So they show, momentum indicators show how fast an asset is moving in a given direction. These indicators are typically displayed as what we call oscillators, which fluctuate above and below a baseline to indicate how much positive buying or negative selling momentum a stock is experiencing. Now, some of the most popular ones are RSI, Relative Strength Index. RSI represents by a chart that tracks an asset's price on a scale of 0 to 100. These are called bounded oscillators because they're bounded between, no matter what happens, when you use their mathematical formula, they'll always come out between a 0 and a 100. And the range that they're important would be above 70 and below 30. So we have things like stochastics, RSI, Chandy's momentum indicator, CCI, commodities index, and Williams %R. Now, most of these indicators are placed directly on charts. And most of the indicators fall below the chart. So as you see here we see RSI, it's on the bottom. Most indicators, very few, are actually put on the chart over type price action. There's some. Bollinger Bands are put on their support and resistance line, but most indicators are put on below the chart. Now, RSI is what we're talking about. It is called a bounded oscillator, and its numbers will always come out between 0 and 100. And between the 30 and the 70 area doesn't give us much indication. When the market jumps over the 70 or below the 30, it generates buy and sell signals or overbought and oversold indicators. But we can also see the momentum of the move down below. Okay, so we have RSI, stochastics, and these indicators, you don't have to know the calculations, and you can see on the right-hand side here all of the indicators that you can get. So we're going to go down to stochastics, and all of them are always dropped on the charts where they belong and using the standard acceptable numeric values. You can change them, you can change the inputs. There's a lot of gurus out there telling you to adjust it to that or this. But so as you see, so down below we now have stochastics dropped on our chart. It is also a bounded indicator and tells us above 80 and 20. So therefore, would you want to be using two indicators that give you the same general information and fit in the same category? The decision's yours, but you don't need hundreds of indicators. In fact, the simplest trading systems are one indicator, some trend lines, some support and resistance lines, and that's all you really need. But other traders like more complicated systems, but wasting your time on indicators that duplicate each other are sometimes valueless to you. So that's one of the reasons why you should know what area they fall into. So here's a simple system with RSI down below and then using Fibonacci retracements directly on the chart and trend lines. So now we cover momentum indicators. Another one that's very, very important, a category, is called volatility. Volatility measures how large an asset's movement is in a given period of time. And this is really important because if you don't know how volatile the asset is or how volatile the market is, you don't know how to judge your support, your profit and risk reward, and where to put your stop loss. Because if you don't know that the euro US dollar is bouncing up and down 18 points today, and you don't know where to put your stop loss, you've calculated what you can afford to lose, but you can't see that the actual volatility in the market today is high, and therefore it's going to bounce below where you can afford to lose, and you're going to get stopped out all the time. Okay. So volatility is a measure of the movement of an asset in a period of time. Okay, and you can determine its volatility. Volatility is a very important indicator for traders because volatility makes it easy to profit due to price inefficiencies. Without volatility, trading opportunities would be limited. Volatility is so important that one of the most important indexes or indicators in the entire world is called the VIX, and it's sometimes referred to as the fear and the greed indicator. But in addition to VIX, because VIX only really works well for the stock market, traders use volatility metrics such as true average range, Bollinger Bands, and envelopes as trading indicators. Now, in each of these categories, we have the prime indicators, and we also have those that fall into the area of leading and lagging. So under that first group that we talked about, trend indicators, we had moving averages. Remember, I showed you those on chart. They're a lagging indicator. Then we have MACD, which is my favorite of all, and that's also a lagging indicator. Now we have a complicated one called parabolic stop and reverse, and that's a leading indicator. But there's not many leading indicators in the market, but that doesn't mean they're good or bad, remember. So remember, trend indicators measure the direction and strength of a trend. We should always be aware of how strong that trend is moving. As price moves above its average, it can be thought to be a bullish trend. When price falls below its average, it signals a bearish trend. So remember, leading gives signals when the trend is about to start. They try to predict price by using a shorter period in their calculations, thereby leading the price movement. The most popular leading indicators can be stochastics, MACD, and RSI. Now, even though we said that MACD is a lagging indicator when we just look at it in trends, because MACD also shows overbought and oversold conditions as well as divergence. Those would be leading indicators because that indicator gives us three different pieces of information. Then we have lagging indicators. Okay, again, and those are that follow price action, nothing bad. They give a signal after the trend or the reversal has started. Use them to determine a trend. The most common lagging indicator is the moving average. Then from here, we go over to momentum indicators. And three of the most popular momentum indicators are stochastics, leading, CCI, Commodity Channel Index, leading, and RSI, leading. Now, many traders come to me and say, Barry, I use stochastics and RSI. Now, I look at them like they're crazy. Doesn't mean you can't, but they both are serving the same general purpose. So why would you use two things to understand the momentum of the market? Now, it's become so common, there's actually an indicator called stochastics RSI where they've combined them together. Now, these technical indicators may identify the speed of price movement by comparing the current closing price to the previous. So as I said, we have stochastics, and it's used to predict price turning points. We have relative strength index, which measures recent trading strength, velocity of change, and the trend and magnitude of a move. Now, the momentum is a measure of speed at which the value of a security is moving in a period. Momentum traders focus on stocks or assets that are moving significantly in one direction on high volume. Then we have volatility indicators, and we talked about why volatility is important. It measures the rate of price movement regardless of direction. Doesn't care whether it's going up or down. It tells you how volatile the market is. This is generally based on the change of the highest and lowest historical prices. They provide useful information about the range of buying and selling that take place in any given market and help traders determine points where the market may change direction. Now, Bollinger Bands is the most common volatility indicator, and it serves other purposes, but when the bands contract, they show you that the market has are low volatility. When the bands widen, they show you high volatility, and they're constantly adjusting. And then we have ATR and standard deviation. But let me show you Bollinger Bands. They're one of the more popular indicators, and one of the ones that actually drop right on the chart, price chart. Oh, I just found it back. Here's my chart using volume. And you can see how volume down below, up or down, and how it's reflected in the price movement of a particular asset. And you can actually do full interpretations on the volume. Now, Bollinger Bands, as I was just saying, let me turn up the moving average lines here. And now we have Bollinger Bands. Okay, Bollinger Bands are envelopes. We have the upper band, the blue top band, and the blue lower band. And these are the bands of the Bollinger Band. And as those bands widen, it tells us the markets are more volatile. As they narrow, it tells us there's less volatility in the markets. In fact, there is a trading strategy based on the breakout, because when the markets have low volatility and prices moving in range bound, we know sooner or later they're going to either break out up or down. And when it breaks to the upside, you would trade that asset going up. When it breaks to the downside from the low volatility, because sooner or later an asset has to move. And you can see how wide here, how volatile the price was. Same time, we have an up move. This tells us we have an uptrend as price rides the upper band. Okay. Now, there's lots of ways to use Bollinger Bands, but one of the most prime ways is to actually see market volatility. Now, all this is also included in your handout. So it's all shown to you with the examples and everything else that you can. And then we also have volume. Okay, and I showed you volume on that other chart just a minute ago. These technical indicators measure the rate of price movement regardless of direction. Okay, volume indicators measure the strength of a trend or confirm a trading direction based on some form of averaging or smoothing the raw volume. The strongest trends often occur while volume increases. In fact, it is the increase in trading volume that can lead to large movements in price. And we have Chaikin oscillators, on-balance volume, and volume rate of change. Some are leading, some are lagging. I use just simple straight volume on my charts. Volume can be added to your charts and is added below. And you can move it around and put it on your charts where you want, but it's done. It's dropped below the price chart, and it's done as usually a bar chart, and the green means buying and red means selling. And we can see the increase in volume as price was moving up. Look at this increase in volume as price was moving up along this trend line here. That's confirming that the trend line is moving very, very strong. Okay. We can see as that broke its support resistance level and bounced off the band, we can see the drop in volume, which is confirming that that trend has actually ended itself. Okay. So we have volume and volume indicators. Now, these technical indicators measure the strength of a trend based on the volume of shares or contracts being traded. The volume of trades is a very important component in trading. It is, for example, used to confirm or infirm a continuation or a change in an asset's direction. Many indicators are also based on volume. For example, the money flow index is an oscillator tied to volume that measures the buying and selling pressure using both price and volume. Now we also have indicators that show us what we call overbought and oversold. Okay. Now these do not fall into any of those 5 categories. Okay. Indicators can show this in conjunction to their other primary features. Like RSI and stochastics will show us when a market is overbought and oversold. So will MACD. Overbought is not defined as a buy or a sell. Oversold isn't defined as a buy or sell. It's telling you there's been too much buying going on and the price is too heavy. But it's not telling you the price is going to fall at that moment. It's just telling you it's too much buying, too much. So you're going to be looking for, if you're looking to enter the market, you wouldn't be entering a market then. And if you're already in the market, you would be looking to exit. Okay. And it's based on indicators that they go above or below a number. So when a security is overbought, the implication that buying has pushed the price too far up and a reaction called a price pullback is expected. When an asset is oversold, the implication is that selling has pushed the price too far down and a reaction called a price bounce is expected. Now, indicators serve three broad functions: to alert, to confirm, and to predict. As an indicator can act as an alert to study price action a little more closely. Nobody or no smart trader trades strictly from an indicator. In fact, indicators are used as secondary decision-making processes. If momentum is waning, it may be a signal to watch for a break of support. Or if there's a large positive divergence building, it may serve as an alert to watch for a resistance breakout. Indicators can be used to confirm other technical analysis tools. If there's a breakout on the price chart, a corresponding moving average crossover could serve to confirm the breakout. Or if a stock breaks support or a corresponding low on the on-balance volume could serve to confirm that weakness. Some investors and traders use indicators to predict the direction of future prices. Now remember, indicators indicate. That's exactly where the name comes from. This may sound pretty straightforward, but sometimes traders ignore the price action of a security and focus solely on an indicator. Indicators filter price action with formulas. As such, they are derivatives and not direct reflections of price action. This should be taken into consideration when applying analysis. Any analysis of an indicator should be taken with the price action in mind. In other words, don't ever let an indicator overshadow price. Price is your ultimate dominating factor. Always look at the price on the chart. Make your decision based on the price of the chart. Use the indicator to alert, confirm, or support your decision. Any analysis of an indicator should always be taken with price action in mind. What is the indicator saying about the price action of a security? Is the price action getting stronger or weaker? Even though it may be obvious when indicators generate buy and sell signals, the signal should be taken into context with other technical indicators or analysis tools. An indicator may flash a buy signal, but if the chart pattern shows a descending triangle with a series of declining peaks, it may be a false signal. Or most indicators that give you buy and sell signals don't tell you how far that asset's going to go. So many times you can get whipsawed in and out of an action because it gives you a buy, but 2 minutes later it's giving you a sell because at that 1 second it was a buy, but you couldn't cover the spread and you couldn't enter the market fast enough. Okay. So you have to understand what the indicator is telling you. As always, in technical analysis, learning how to read indicators is more of an art than a science. The same indicator may exhibit different behavioral patterns when applied to different stocks or assets. An indicator that works well, say for IBM, might not work well for Delta Airlines. Through careful study and analysis, expertise with the various indicators will develop over time. And this is it, your expertise with an indicator. And this is why you shouldn't be using a zillion of them, because it can take you years to become an expert and know all the ins and outs and intricacies of a particular indicator. So when you're trying to combine Bollinger Bands, MACD, RSI, stochastics, you know what? You can't be a master. I've been training with MACD for 25 years. It is my favorite indicator, and I still haven't mastered every nuance of it. So as this expertise develops, certain nuances as well as favorite setups will become clear. Now, there are hundreds of indicators in use today, with new indicators being created every week. Technical analysis software programs come with dozens of indicators built in. As you see, when we looked at the trading view indicators, okay, there were literally hundreds of them we can add under our charts. Given the amount of hype that is associated with indicators, choosing an indicator to follow can be a daunting task. And it's very true today, because we can dump so much content in the market. In the online trading world, it's all based on content and information. YouTube videos and articles that some guru is pushing out there that hasn't even tested. But all of a sudden, everywhere you go and you look something up or you look up strategy, this guy's stuff is coming out, and so you think he's an expert. Donald Trump and his false news isn't wrong, okay, or his fake news. There's too many indicators that are so new on the market that they just haven't been tested. Okay. So even with the introduction of hundreds of new indicators, only a select few really offer a different perspective and are worthy of attention. Strangely enough, the indicators that usually merit the most attention are those that have been around the longest time and have stood the test of time. The most popular ones, like RSI, stochastics, have been around for 50. They weren't even developed for online trading. They were developed for stock markets and future, not even an agricultural trading. Years before we had computers, they were done by hand, and they've been tested year after year, market after market, sector after sector, and they have withstood the test of time because they work well. Strangely enough, the indicators that merit the most attention are those that have been around the longest and have stood the test of time. When choosing an indicator to use for analysis, choose carefully and moderately. Attempts to cover more than 5 indicators is usually futile. To me, attempts to use more than 3. It is best to focus on 2 or 3 indicators and learn their intricacies inside and out. Try to choose indicators that complement each other, instead of those that move in unison and generate the same signals. For example, it would be redundant to use 2 indicators that are good for showing overbought and oversold, such as stochastics and RSI. Both of these indicators measure momentum, and both have overbought and oversold levels. So remember, divide them down into leading and lagging, divide them down into the sectors that they cover, and then decide the one you like. Just pick one for some reason that you like. Okay. There is no guarantee that yours will be better than mine. But start out with one of the most common ones. Start out with an easy one. I started out with MACD because I like the name, Moving Average Convergence and Divergence. Now, for technical indicators, there's a trade-off between sensitivity and consistency. In an ideal world, we want an indicator that is sensitive to price movement, gives early signals, and has few false signals. If we increase the sensitivity by reducing the number of periods, an indicator will provide early signals. And this is what you get out there. You'll find gurus out there telling, okay, well, let's use MACD, but we're going to change it from a 20 period to a 16 period and a 26 period to an 18 period, because that's going to give us more. Well, then it's no longer the original indicator. And in order to know how well that would work, that guru's telling you this is his way of doing it and it's so wonderful and great. But the fact is, it wasn't what Gerald Arpel developed, or Bill Wilder, whoever developed it, all those years ago, and it's been tested in all the market. He's taken an indicator's mathematical calculation and adjusted it. Well, then either he's got to show you the back testing, or you've got to test it for a very, very long time to see if it works well. So remember, we have oscillators, and most of them fall, or a good deal of those fall into oscillator types. And there are many different types of oscillators. Some belong to more than one category. The breakdown of oscillator types start in centered oscillators, which fluctuate above and below a center point, or a line or banded oscillators. Okay. Now, as I said, I keep preaching MACD because it's one of my favorites, and we have several classes on MACD. MACD is unique in that it has lagging elements as well as leading elements. Moving average or lagging indicators would be classified as trend following or lagging element. However, by taking the difference of the moving average, and MACD incorporates aspect of momentum or leading elements. The difference between a moving average represents the rate of change. By measuring the rate of change, MACD becomes a leading indicator, but still with a bit of lag. With the integration of both moving average and rate of change, MACD has forged a unique spot among oscillators as it's both a leading and lagging indicator. So on that note, I'm going to say goodnight to you. I've incorporated all of this in the handouts you've got, and hopefully you'll be able to read it when you have time and follow along and learn how to use technical indicators successfully. Thank you very much. And if you want, go to www.alvexo.com and click on their education tab. They have lots of ebooks, lots of videos. You can sign up for one-on-one classes. You can sign up for their webinars, and you can learn all about technical analysis and trading from the very beginning for the intermediary trader, for the advanced trader. And like I said, they'll also set you up with a one-on-one financial analyst. So thank you very much for joining us, and have a great night now. Bye now.